In this video, I'm going to take you through what the recent changes regarding the Bank of Canada and those future implications. So as of July 24th, 2024, Bank of Canada reduced its prime lending rate by a quarter point the second month in a row. Same thing happened in June 2024, a quarter point. So currently the Bank of Canada prime lending rate is 6.7%. And we're going to look at what I think the formula is to look at for future rate decreases. Hi, my name is Deirdre Dunn. I'm a real estate broker in the Wellington and Waterloo regions of Ontario, and I help empty nesters downsize, reducing the stress, anxiety, overwhelm that often happens with downsizing using my 5-step method I call your next chapter. So before we begin, if you could subscribe and like this so that more people like you can see videos like this, I'd really appreciate it. Thanks. So let's look at what's happening with the Bank of Canada and future implications, especially around real estate and what's happening there. So as I said, the second Bank of Canada rate decrease has happened in July 2024, and it went down by a quarter point. Interesting, between March of 2022 and July of 2023, there was 4.75% increase in the prime lending rate. Unprecedented. And if you broke that down into quarter points, so 0.25%, there would have been 19 increases in a row to make up that 4.75. So, and that's typically how historically the Bank of Canada worked. You'd see a quarter point, maybe a half point, but it was unprecedented. At one point, they took a whole percentage point increase. So that's what's happening right now. And just to clarify, the Bank of Canada rate influences the variable rate mortgages. Fixed rates are tied to the bond market, and the bond market was indicating about 90% that there was going to be a rate decrease. So just clarify that this quarter point that has just happened is going to influence variable rate mortgages, and it's either going to reduce by about $15 or $16 per 100,000 per month, or it's going to reduce your amortization a little bit. So that's what's happening. Now, we have to be aware of what's coming in terms of mortgage renewals. That's really going to impact the real estate market. So if you haven't heard, there's this wave, probably more like a tsunami, of mortgage renewals that are coming 2025, 2026. Something like 60% of mortgages will renew. Well, all the major banks can't afford to have those renewals happen. They can't have people default and have that on their books. So we're going to have rate decreases. It's just a matter of when and how much that's going to happen. Because otherwise, what's going to happen if any of those were to renew today, the implication would be that people couldn't afford or absorb that rate increase. And how it works, just to remind you, so we have a stress test. So back in, let's say, 2021, you would have maybe gotten 2.5% mortgage rate, which was unbelievable rate. But you had to qualify at 2% more. That was the stress test. So you'd qualify at 4.5%. Well, today, if you had to renew, you wouldn't have a mortgage at 4.5%. You'd probably be in the high fours at minimum, likely in the 5% range. And so that means that you'd have much greater amount to absorb in your daily living costs, meaning that you'd also have less spending disposable income, things to buy, large ticket items, cars, entertainment, renovations, things like that. Well, that is slowing the economy down. So right now, the unemployment rate is at 6%, which is exactly what the government really wanted, unfortunately. They increased interest rates so that the economy would slow and there would be an increase in unemployment. And they've gotten that. But the side to that is that also wage growth is not keeping up. So not only is your mortgage renewal coming up in the next 8 months to probably 2 years from now, but your wage growth isn't happening. Again, tying back into that disposable income, and that's what the government's looking at very closely. So the third rate cut is likely to happen given the formula that I'm going to tell you. And it's probably the next Bank of Canada meets September 4th, and the next one after that is the late in October 2024. So right now, if we have a third, which I fully expect that we're going to have a third rate decrease, those will neutralize the three increases that we had in 2023. They happened in January of 2023, June and July of 2023. All of them were a quarter point. So right now, and the Bank of Canada prime rate is expected to end at the end of this year between 6.2% and 6.45%. And how that translates into variable rate mortgages with discounts, we're anticipating with at least 3, possibly 4 rate cuts this year, variable rate mortgages would end 2024 somewhere between 5.2% and 5.8%, depending on discounts and your consumer profile. So that would bring rates back down to where they were at the end of 2022. So what the government is looking at right now are 3 things: inflation rate, GDP growth, and unemployment rate. And here's the formula that I mentioned earlier. So if inflation and GDP decline while employment stays the same or increases, then we're probably going to have 4 rate decreases this year. So those are the 3 things to really keep an eye out on: is inflation rate. Is it going to stay stable? Is it going to go down? GDP growth, what's happening with it? Is it stabilizing or increasing, decreasing? And unemployment rate. So the 2 that we want to see decline is GDP and inflation rate, and we want the unemployment rate to either stay the same or rise a little bit, meaning that it's putting pressure on consumers that they won't have disposable income. And without that disposable income, the whole economy slows down. Again, saying because you have less money to spend on big ticket items, entertainment, renovations, things like that. So those are the things that I'm looking at, and I thought you'd be interested in knowing that too. And before you leave, if you haven't already, subscribe and press the like button so that more people like you could see videos like this. I'd really appreciate it. I'll see you in the next video.